This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Welcome to the show, folks. Today we're diving deep into the art of the pitch deck. Remember, it's not about overwhelming your audience with every detail, but about nailing down the core information. What's your product? Who's on your team? Why are you raising funds? Stick around as we uncover the essentials for a compelling pitch.
So, yeah, sometimes it's the simple things, right? But simple isn't easy. So,
right.
Yeah.
Well, I always tell people you want the introductory version of your deck, not the be all and end all that shows you every possible component, because it's too much. They just want the core information, one product, one team, one raise, that type of thing.
Yeah, exactly. How much do you want? Why are you doing it? What's your current pro forma? Give me a snapshot of your financials. Who's on your board? Who's on your team? Do you have advisors? Who are your customers? Who are your channel partners? And that's it, right?
Right.
Yeah.
That's a good point. That's a good point. Mm-hmm. Well, cool.
So, yeah. So tell me a little bit about how your organization works.
10 Capital at heart, what we do is we're running investor relation and introduction campaigns to the early stage, seed, Series A, Series B, mostly, not pre-seed, where it's two guys and an idea, but those who have something. And they come to us because they've run out of investors. I've talked to everybody in my network. Now what? Will come to us and we'll put you in front of more investors and other investors in either here or other parts of the country. So we take people and we put their an introductory mailer together, send it out to our network, and build a list of initially interested investors, 50, 60, sometimes 100. And we're then inviting them to come hear you pitch in our online events. Introductory presentations are all online right now. And then we pull everybody who wants to learn more about it, make introductions, and then we start going through and do other type of events. We do investor update events. Those are very effective. We invite our investor prospects to come in and listen to you give a standard investor update to your own investors, and you showcase the team. And I find that really has a good closing effect because they get to see the entire team, not just the CEO, and hear existing investors talk about what's going on. Now they can get the visibility of this is what I will be joining if I invest in this company. And sometimes that can be very compelling. We also do special events. We bring a thought leader to come and talk about what's going on in your industry. They have a little bit of content, usually doubles the number of investors coming to the room because they're learning something in addition to a pitch. And those work very well. We also go to angel groups as we're doing Keiretsu. We also go to C10 and all the other angel groups that are out there, and we go through that process if that's a fit for what we're trying to do. And then we have VC funds that are specific in the space that we target as well, making introductions there. At the end of it, we often find that there are investors who are interested, but they're not closing, and so we run in-person events. These are either 10, 15 people at a dinner, nice restaurant, come on out, 3 hours, let's go through everything. And at the end, you make a decision, get about 30% close rate on those things. But we do get people to make a decision because we're going to close in 3-4 weeks. That makes a big difference. I find Zoom is a great way to educate people, get them interested, but it can be hard to close. In person is much easier to do that because they get to meet you. So those are the things we do. Remember the days of cable wrangling for connectivity? Well, imagine a seamless, line-of-sight free solution. It's a game changer for smart buildings and IoT. This technology is poised to revolutionize the industry. Stay tuned to learn more about this remarkable development.
It's essentially a backhaul network in a building. So it enables all the IoT in a commercial building, whatever the case may be, if it's industrial manufacturing to multifamily to office to medical. So and it also works outside, so it can connect a campus. So depending on how close or far the buildings are apart, you can use it outside to connect buildings on a campus.
Right. So telecom's a good fit. There's recurring revenue in there. Once you install it, it's very sticky.
They do have recurring revenue. And I've talked with them about this too as an advisor. It's initially upfront, it's, you're just paying for the one-time hit for the actual product, but then there is recurring revenue for the software upgrades and the maintenance of the solution. So,
right.
Yeah.
And then
So it does
typically
have
there's
that
add-on
component.
things you can do with that as well. Other additional
Yes,
services come in so you can incrementally ooch it up
correct.
over time. So a lot of good things to
Hmm.
like about it. Looks like, good disruptive technology. I remember these
Hmm.
systems from way back when they actually had to wire cable through the buildings and so forth. And it was
Right.
a real challenge. And today, if you can just pop it in and it goes through the wall, then you solve a lot of problems. It's not just line of
Yeah.
sight, which is what most of them used to be. So it sounds like a very compelling technology.
Yeah, I think someone will buy it easily. I think someone from like Ericsson or Nokia or one of those types of companies may buy it because it is unique and it's an online of sight and it enables you to put it in buildings or in like luxury residences if you're trying to expand the coverage and increase the capacity and you don't want to have to tear up walls to do that. And also, it enables smart buildings. So when you're talking IoT, that's the key, right? And then it works with any technology, whether you're using CBRS, 5G, private LTE, Wi-Fi 6 or 7, it doesn't matter. And it works with any end equipment. So, it doesn't matter if you're using Ruckus or Cisco or Ericsson, it's going to work.
Okay.
So,
Sounds like it's
yeah.
well installed in the ecosystem there as well. But yeah, well, love to talk more about it. If you
Okay.
have a deck, love to see it. And I'll send you an email about how we work. You can share it with the team and see if
Okay.
that's a fit for you
Sure.
guys. Jump on a call with people that have additional questions. We do that all the time and see how we run a campaign in this particular case. Love to have thought leaders come in and talk about what's going on in this space. This would be a good one because not everybody is up to speed with the current technology here, and that's true of most. And it's hard for investors to keep up with all of them anyway. So that would attract a lot of people into the deal.
Yeah, that reminds me too. So their chief engineer, he's based in Austin because he's here because they make the product in Texas. So it's made in the US.
Oh, great.
So,
That's good to hear.
And another great thing for, doing a raise in Texas is it's a Texas made product. So it's made in Garland, actually, is where the manufacturing facility is.
Yeah,
So
my niece that lives in Garland. So
yeah.
good place to do it. Lots of manufacturing capability there as well. And people are kind of moving away from China, kind of doing reshoring. So
yeah.
ahead of the curve on that one.
Yeah, definitely.
Let's talk about strategy, folks. We've got a funding round nearing its goal. It's not just about securing commitments, but creating urgency. We're breaking it down, how interest and committed amounts play a pivotal role. Plus, we've got some insider tips on running successful investor relations campaigns. You took all of their interest and committed amounts. How much would that add up to be? Because you have 700 left, but what is the interest and committed on this?
So interested committed is about another 500 on top of the hard commit that takes us to 800. So we're just a couple 100,000 short of filling the round beyond the interested committed. And that's when I'm summing up like the Broad Street and the AIF and those guys.
Right. Because one of the things we like to do is break the raise down into tranches so we can then run deadline campaigns. And one of the biggest things is if you have more interested committed than available funds, I've got 500 left, but interested committed is 700. That starts to create a little bit of the FOMO. And so you put out there in 6 weeks for closing. We have 700 interest, only 500 left, but it's first come, first serve. And then typically what you do is you put a follow-on raise after it or no raise after it. So people, they either have to get in now or they're going to miss it. So that's one thing we often do is try to show that there are other investors in the deal. And these are real interesting committed. It's not made up numbers. It's got to be real.
Oh, yeah. I think that might dovetail nicely. So in addition to the ones that I rattled off to you, I'm pitching to several more next week that
add to the list.
Yeah, 757 Angels, which is one of the biggest in the nation. Virginia Innovation Partnership has a Virginia Venture Partners I'm pitching to next week. And then I'm going the week after next, I'm going to an event in Richmond and an event in Cleveland that I'm going to be doing these rapid fire, pitch things. So that interested number could jump up here in 2 weeks to, well over 1 million.
Right. Okay. Well, then that should do it. So That's kind of what we do is we run investor relation campaigns, and we're running these deadline campaigns to push people into it. And then the other thing we do is in-person events. Sure, we're talking on Zoom, and in some cases you may be in their room, their pitch room and so forth. But what we like to do is invite them to a dinner. Those who are seriously interested, come out and let's spend 2 hours, have a nice dinner together, build the relationship a little bit. They get to know you a little bit. And after 3 hours, they feel like they know you pretty well. And that's part of this game is you have to build a relationship.
So I agree with you 100%. That was the most effective engagement I've had because it was live. And today, you have so many of these that are Zoom. And that's why I'm excited about going down to Richmond and over to Cleveland, because I know when I spend time directly with people, it's more effective by a lot.
Right. And so that's a coupling there as we're driving to that 6-week deadline we're putting out there. If you want to say the first week of December, that's fine. Gives you a week, 2 to finish it out, the paperwork and all that. Then you've got, so if you did 6 weeks from that, that would be mid-October. You have to put out there it's a 6-week closing, and we're trying to do it. Some people try to use Thanksgiving as the close, but that gives you the first 2 weeks of December to do the wrap up, final docs and so forth. The other thing we do is we DocuSign everything. So anything they're doing is just a email with a click, and then you're walking people through the diligence box if they didn't make it to the dinner. And that's another technique is to send them the diligence and say, yeah, I want to show you where, and then get on a call or Zoom and you walk them through and show them everything. And then as you show them, they ask you questions. And when they do, you answer it right then and there. And when you get to the end of the box, you ask if there are any other questions. If the answer is, well, no, I think you answered everything. Well, next step is just we've done our diligence there. And next thing is send them the wiring instructions, and you put them on that part of the list to see if you can move the money through, and then it's done. So it's always baby steps in these things. But the dinner, I think, is the heart of it, because you really have to have that time where you really go through and convince them this is it and answer all their core questions, and then you can move them through the rest of the steps through Zoom and phone calls. Get ready for some expert insights. Closing deals is an art, and we've got the brushstrokes for you. We'll walk you through the process from term sheets to diligence boxes. It's about guiding investors seamlessly through the paperwork. And don't forget the power of face-to-face interactions. Dinner meetings can be the heart of building those crucial investor relationships. Stay tuned for more transactional tips.
So from a deal docs, we have an attorney that, handled that. You would just latch up to that. I mean, they have, they do all of the filings, all the,
Right. So everybody's got their term sheet or convertible note or safe note or equity agreement. We're just trying to get people moving through the process to read it, understand it, agree to it.
Yeah. So you're basically facilitating those transactions with, qualified investors that, like you say, you time box them, you organize dinner event, make sure that it's, steadily closing, it sounds like, is how you operate.
Right. So when people in our program, we do find investors. It sounds like you found most of the ones you need already, but we can find you more. The first step after you pitch is, are you interested? The answer is yes. If it's a no, it's a pass. Okay, we take them off. But if it's a yes, well, then what are you thinking of? And is 50 to 100K? They give you a range. You get it down to a number like it's 75. And this may, each week you're calling and kind of having another interaction, or maybe twice in a week as much as you can do. And then once you have a number, well, then next step is you say, well, a lot of our guys have asked what the term sheet looks like. I'm going to send it to you just so you can see what it looks like and read through it if you have any questions. And it's just because other people have asked us, I'll send it to you. And if they come back and say, yeah, okay, I got that and so forth, I read it. Then the next step is I'm going to send you the diligence box, and let's set up a time to do a walkthrough. I want to show you where everything is, and see if you have any other information you need. And then the goal of that is to get them in the box, going through, asking questions. And if they need more information, you figure out what that is. Otherwise, if you just send them the box and you don't hear back, you don't know what the next step is. Did they read it? Did they not? And so forth.
Yeah, transactional. Yeah, that
Right.
makes
You
a lot
get
of
just get
sense.
in there with them a little bit and figure it out and make sure we do it. And then, like to say, at the end of that, they've signed the term sheet, they've done the diligence. Well, I guess we've done it. And the value of the dinner meetings is they can sit in a room with other people. And if somebody invests, you then ask them, well, other people are interested in why you invested. Can we, will you be a reference for them, so to speak? And so if two people and a 10-person dinner invested, you take them and say, okay, to the other 8, if these guys came in, if you have any questions, you can always ask them why they came in and so forth. You have to get permission first, but that's the other thing is, again, it's you're giving them access, giving prospective investors access to existing investors to figure this out. Here's a prospect recording that has a number of interesting segments, including my background at NI and also how to structure a fundraise. So 10 Capital was originally called Texas Entrepreneurs Network. I started started in 2009. I started 3 angel networks in Texas back in 2006, 7, and 8. I started C10 in Austin, Baylor and Waco, and Wilco in Williamson County. Had more fun doing this than I was doing my day job. I was with National Instruments. They went public in 95. I started doing angel investing after that. After 24 years, what was a small company was a big company, and it was less interesting. So I retired from my day job and started doing the angel thing full time. And at heart, we were doing investor relations and introduction programs in Texas. From 2010 to 15, I was flying I needed more VCs for my Texas deal. So 1 week to the Bay Area, next week to New York, and then back to the Bay Area. Nice. And that's where they were back then. Today they're everywhere, but back then they were kind of clustered in those spots. 2016, a whole bunch of family offices came into our program because they didn't want to pay the fund fees anymore. They wanted to go direct. And some cases that worked out, in other cases it didn't. And so now they're all hybrid models from what I can tell. And then 2017, I was getting calls from outside of Texas. We had built up about 4,000 or 5,000 investors. Today we're at 20, but back then it was about 5. And I was getting calls from people, startups in Chicago and Seattle and other places saying, well, I've talked to everybody in my town, now what? And they just run out of investors. And that's how we kind of got into it, is when people ran out of investors, that's when you come to us. If you haven't raised from your family and friends, or you haven't gone to the local angel group, we'll do that first, because that's always validation. As you know, as an angel investor, if somebody comes to you and nobody's ever put a dime into it, you're kind of wondering why. But if somebody's put some money in, but they didn't put all of it in, well, that's pretty standard. But it's not possible to get all the money you need from just one local angel group. You really have to have a national perspective, and the pandemic kind of brought that home, because now instead of doing local pitches in person, we're doing online pitches, and they could be anywhere because the introduction's up there. The thing we got into was it can be hard to close if all you have is a Zoom call behind you. So we do that up front because that's kind of the norm. But at the end, we use in-person meetings for it. We go and have a dinner, invite everybody out in the area to come and listen to the pitch, and spend 2-3 hours. And it's how hard as a diligence meeting is what it is. But if you do it over a nice dinner, people will come and be a part of it. And that's one thing we're getting good success with. We get 30-40% close rates with a good closing. And this is for people that already seen the deal, that know something about it, and they're just trying to make a decision. And if they're in a room with other people that are asking good questions and answering and so forth, that can move people to a close. So that's a lot of what we're doing now, is putting in-person meetings. And partly people are, when you're on Zoom 8 hours a day, you really like the idea of going out and talking to people in person, and you really like the idea of a nice meal too. And so this is kind of where I see it going myself. What do you see out there?
So, let me ask you a couple of questions. That's really interesting. So you were at National Instruments around the early days of National Instruments. What's your background? Is it finance, or is it technical, or?
It was technical. I got a computer science degree, and then I came to Austin for an MBA. And then after that, I decided I got a call from NI, and I was employee number 93 overall. But I think I was, when I was there was about 30 of us in the company. This is 86. And then they just kept growing. And in 95, they went public. Today, I think they're at 7,000 people. And that's why I retired, is because it was less about innovation and entrepreneurship and more about budgets, forecasts, and the like. That's why it kind of got less interesting in that case. And it wasn't the great growth story it was in the very early days, but it was quite the ride for sure.
So what happened in our business is I merged my company in the 2000s with another company that had a very small niche brand, and we created a medical device company out of it, and we became the number 2 global player in radiation therapy for positioning patients, which is kind of its own space. And then a VC came and took out our biggest competitor, and then came looking for us, and not a VC, PE. But anyways, so we exited. So we became by far the dominant player when we merged our business together last year, and it's becoming also much more formulaic and so forth.
Yeah, I understand that.
I enjoy the innovation and so forth. That's where my passion lies, in transforming, identifying unmet needs and converting that into products. And I was really kind of a serial entrepreneur under one roof. So we dozens of products that we developed.
Wow, that's cool. You asked me a question on email about how to structure your deal and had some thoughts about it. Is that your main question, or was there something more important to cover?
Yeah, I don't know if Dan told you, but Dan is in the process of coming on board as our CEO. We kind of feel like it's time for somebody with a business background, not just a physician. And so we're looking at, maybe he told you already, we're funded, we've got a runway now about 12 to 15 months from the NIH, and we're pretty hopeful that'll get extended by the NSF. And we know it's a bad time, but we also feel like we're kind of ready to raise funds for our minimal viable product, a cath lab vest. And when we went around and looking for advice, we were getting kind of 2 answers. One or two experts said you should do like $1 million safe to get going on on that product. Others said, no, you really should do like a $5 million, priced round. And so that was a major question.
Right. So what we recommend you do is you figure out, what the major round is going to be, say 5 million is the number. And you break that down into 3 rounds, 3 tranches. The first tranche is going to be the first $750, $1 million. And that's going to be on a safe note or convertible note. So you're not trying to price it just yet. You're not trying to make them climb the valuation wall, like I say. Right. You're really just trying to make it easy for people to get into. And convertible notes and safe notes are easy to get into. And you put a very, very investor-friendly valuation on it. You wanted the overall valuation to be 10. We would put 5 on the first round. And it's just a small amount of money, 500, 750, and we just need a little bit of money to kick off. If you had all $5 million today, you probably couldn't deploy it anyway, but you do have some upfront needs of 500, 750, $1 million, something like that. And so that's what you want to do on the first round. And then the second round, you're going to raise another $2 million of the 5, and it's going to be it went from 5, it now goes to 7, and then the final tranche is going to go to 12, something like that. And the purpose of that is to create some scarcity for that low cost of funding up front, low price funding, I should say. So there's interest from investors to get in. If they want to get in, they want to be first. If the valuation is the same all the way across 5 million, well, guess what? Everybody wants to be the last one in the deal, and we can't all be the last one in the deal. So 5 million is important because it shows you're raising enough to get a meaningful way down the road. If you just raise 750, people are wondering how far you're going to get, and especially in this space. And if you're raising 5 million, it can be hard to get people to come in because they're waiting for somebody else to go first. The other value of breaking into rounds is you get to run deadline campaigns. If you're raising 750, when you get to 500, you say we're closing in 30 days. There's 250 left. Who wants to be in? Oh, by the way, there's 500 of interest and committed swimming around this thing. And it's first one in gets it. Everybody else gets to go to the next round. You don't mind paying more, it'd be a higher valuation. So you structure it that way to show the big picture, but also give yourself structuring along the way to run deadline campaigns and close interested investors so that they know that,
Right.
that it's going to go away. So that's one way to do that.
The first tranche you're suggesting would be a $750,000 convertible or safe. The second tranche, what were your thoughts? I kind of was.
I make that like 1.25 million. So now we've got, between the first two tranches, we've got 3 of it covered. 750, you're trying to make that as easy as possible. And oftentimes family and friends are in that, the local angel group's in that, and that people that know you, if they can do about half of that, that makes it really easy, because they're investing in you, not the business.
Mhm.
And that's what investors are looking for. Does your network believe in you? If the answer is yes, well then, okay, let's go to the next stage. And if the answer is no, well, why not? And so you want to make that real easy. Once you get a closed round, so to speak, the next round gets that much easier, because you say, we've closed this round already. We've got success behind us, and that really helps spin up the momentum. If other people are in the deal, I can be in there too. Part of this, the exercise, is to show that other investors are interested in the deal.
Mhm.
That's why when you say I track what I call the interest and committed, we've talked to them, they're thinking about 50K, or they tell me they're going to put in 50K. That's interest and committed. You want to track that. Everybody that comes through that hasn't said no, they're in the interest and committed. And you just put a number next to it, you add that up, and it can be quite impressive. I've had interest committed be 7 times what was the first round, because there's lots of people swimming around. But in most cases, they're going to see if anybody else goes first. They want to see more traction or progress or what have you in your deal, and you can keep tracking that going forward. So that's the structuring you want to put onto it, and you want to put down for each of those rounds what is going to be the milestones for that, because you have to justify that increase in price. So if I raise 750, I'm going to do something, and that's going to give me the higher valuation. And when I raise the next round, I'm going to hit milestones or achieve deliverables, and then that's going to give me justification for my third. So the valuation still has to map to where you are with the progress of the business. We can't get way out ahead of it. That's why I say start with the first one, what I would call below market rate. This is a really good deal. Everybody else is at 7, I'm at 5. And we're giving you a great deal here for it. And then eventually, when you get to the third round, you're maybe at market or a little bit above.
Mhm. So what happens if you raise the first tranche and you're unsuccessful with the next 2? Then you're.
Well, it's time based. It's we can say we're going to do this in 6 months, but reality is we're going to do this until we get the money in, and then we're going to go to the next tranche. Now, if it really falls back, the market maybe takes a hit, or the economy takes a hiccup, what you end up doing is going back to the first tranche and say, okay, that was at 5 million. I'm going to do another 750 at 5 million. And you lower your valuation for it. You don't go below the first tranche, you equal it. So one thing you'll see a lot of is we talk about pre-seed, seed, Series A, Series B, like it's one step after the other.
Mhm.
What I actually witness out there is this pre-seed, seed, seed plus, another 250K bridge round, now Series A. And that's because we're going from angels in most cases to VC or institutions. And that's a very, very big step up. And seed plus, and Series A doesn't really capture that. But when you get out there, you'll find that the metrics on the VC are really high. And that's why you're doing all these intermediate steps to get from one to the next. And so when you need more steps, what you do is I just raise another round at the same valuation as before. It's not a down round, but it's not an up round either, because I have to hit certain metrics to get to the next level. So you're breaking that second step down into smaller steps is what you're doing.
So are you waiting to take all the money until you've raised all 5 million, or are you taking it in steps?
You're taking it in steps. That's why you do a safe note up front. And it's just very hard to find a lead investor at that stage. When you get to the second, maybe third, now a lead investor may appear. If they appear, that's great. If they don't, we're just on safe notes or convertible notes.
Mhm.
If you're doing a safe note, you want to do a post-money safe note. Investors have learned that pre-money safe notes don't always convert the way they thought they were going to convert, and they're very sensitive about that. And I find that word has gotten out pretty broadly. So a post-money safe note, that means we're just calculating the valuation off the post-money, not the pre-money. Because if I say I'm going to raise $1 million, but I decide to raise 2, well, that's going to change your ownership on a pre-money. on a post-money safe note, that doesn't change the ownership conversion.
Well, so let's say we go into a 3-phase process that goes on for years. How do we interact with you during those years?
Well, what we do is we run investor relation campaigns. You sign up today. We have an onboarding call tomorrow. We engage our network in a week, and we're going out and we're getting investors interested. And it's $3,000 a month for a 3-month commitment, and after that, it goes month to month. So we could be there for just the first round, 3-4 months, or we could be there for the first 2 rounds, 6-9 months. And I've been in people's program for 2.5 years because they use this for the pre-seed, the seed plus, the Series A, and we're now working on Series B. They just never stop. And they took the investors from one campaign to the next is what they did. So it's your choice how you want to use it. But up front, we can go and help you get this up and running and at least get the first 50 closed after a certain amount of time. And we can be a part of that. We're not a broker. There's no back end fee. It's just that upfront. It's just that monthly retainer. It's $3,000 and it doesn't change. And as I say, we often do most of our things online, but we're now putting in-person dinner events to close investors. So we're running those closes. If we find we have 10 people in the Bay Area or 5 people in New York, we're inviting them out for a dinner. And we're going through and trying to do a close because you'll find this market closing is a bit of a challenge. People are very slow to part with the money, but if they come out and you answer all the questions, they'll do that. You've got about 30-40% success rate with closing on those things. That's a wrap for today's show. We've covered everything from pitch deck essentials to cutting edge tech and effective funding strategies. Remember, it's not just about the numbers, it's about the connections. Thanks for joining us on the Investor Connect podcast. Until next time. Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.